What if everything you learned about Warren Buffett missed the most important part? The conventional story tells you about a folksy Nebraska investor who read financial statements, bought undervalued stocks, and became one of the richest people in history through patience and wisdom. That story is not wrong, but it is incomplete. Because beneath the homespun aphorisms and the annual shareholder letters lies a mechanism so elegant, so powerful, that it transformed a struggling textile mill into a machine that generates wealth with mathematical precision. Most investors tried to beat the market. Buffett built something different. He built a structure that extracts value from market inefficiencies while operating outside normal constraints. Between 1965 and 2023, Berkshire Hathaway delivered compound annual returns of 19.8%, nearly double the S&P 500's 9.9%. A dollar invested in 1965 became $43,206 by 2023. That is a 43,206-fold return in 58 years. The usual explanations focus on value investing, on buying great companies at fair prices, on holding forever. But they miss the hidden architecture. What if I told you that Buffett's real advantage was not picking better stocks, but accessing a form of capital that costs less than zero? Let me show you how a man who started with $105,100 in 1956 built a fortune exceeding $120 billion by discovering a pattern that operates today exactly as it did 6 decades ago. Warren Edward Buffett was born on August 30th, 1930 in Omaha, Nebraska, during the early tremors of the Great Depression. His father, Howard Buffett, was a stockbroker who would later serve 4 terms in Congress. By age 11, young Warren had purchased his first stock, 3 shares of Cities Service Preferred at $38 per share. He sold at $40, watching it later climb to $200. The lesson stayed with him. In 1950, Buffett discovered The Intelligent Investor by Benjamin Graham, a book teaching a revolutionary concept. Stocks were not abstract tickers. They were fractional ownership in real businesses with intrinsic value. When market prices fell below that value, you bought. Buffett immediately applied to Columbia Business School to study under Graham. He studied under Graham and David Dodd from 1950 to 1951, graduating as Graham's only A-plus student. After brief work in his father's firm, Buffett joined Graham Newman Corp. in 1954, earning $12,000 annually. For 2 years, he absorbed Graham's methods, buying companies trading below liquidation value, holding until the market recognized the discrepancy, selling. Cigar butts with one last puff, Graham called them. The approach worked through disciplined quantitative analysis. But in 1956, Benjamin Graham retired and dissolved the partnership. Buffett, at 25, returned to Omaha with $174,000. On May 5, 1956, Buffett formed Buffett Partnership Limited, with 7 limited partners contributing $105,000. Buffett contributed $100. The structure was revolutionary. Buffett would receive no management fee, but he would take 25% of all profits above a 6% annual return. His incentives aligned perfectly with his partners. The first years followed Graham's playbook: undervalued stocks, arbitrage opportunities, special situations. By 1962, the partnership had grown to $7.2 million. By 1965, it managed $26 million. Buffett's returns exceeded 29% annually, while the Dow averaged just 7.4%. Think about what this meant in practical terms. Buffett was not just finding undervalued stocks, he was building something larger. The conventional explanation stops here, at the story of a talented young investor outperforming through superior stock selection. But the real transformation was about to emerge from an unlikely source, a failing textile mill in New Bedford, Massachusetts. The pattern that would define Warren Buffett's legacy began not with brilliance, but with frustration.
In 1962, Buffett began buying shares in Berkshire Hathaway, a New England textile manufacturer struggling against foreign competition. The company had been liquidating factories and buying back shares. Buffett calculated he could profit from each cycle. But in 1964, Berkshire's management offered to buy Buffett's shares at $11.50. He agreed. When the actual tender offer arrived, it was for $11.375, an eighth of a point less. Buffett was furious. Instead of selling, he bought more shares. By May 1965, he had acquired control. He fired the manager who changed the price. This was not rational. This was emotion. And it led to what Buffett himself would later call his worst investment. Berkshire Hathaway was dying. Revenue was falling. Foreign manufacturers could produce textiles cheaper. No amount of capital would change the fundamental economics. But Buffett now controlled the company. He had to do something with it. What he did next revealed a pattern most people still do not understand. Instead of trying to fix the textile business, Buffett began using Berkshire's cash flow to buy other businesses. In 1967, Berkshire acquired National Indemnity, a small insurance company in Omaha, for $8.6 million. On the surface, this looked like simple diversification. But here is what most people do not understand. Insurance companies collect premiums up front. They pay claims later, sometimes years or decades later. That gap creates something called float. Float is money that belongs to policyholders but sits temporarily in the insurance company's accounts. Traditional insurance companies invest this float in safe bonds earning 3 to 5% returns. But Buffett saw something different. What if you could use that float not just to buy bonds, but to buy entire businesses? What if the insurance company became a subsidiary that could deploy capital wherever returns were highest? Think about the implications. Insurance float is leverage, but with a unique characteristic. If you underwrite policies profitably, if premiums exceed claims and expenses, then the float costs you nothing. In fact, it costs less than nothing. You are being paid to borrow money. Let that sink in. In 1967, National Indemnity gave Berkshire approximately $17 million in float. By 1970, Buffett had acquired additional insurance operations. The float grew to $39 million. He used it to buy See's Candies in 1972 for $25 million. See's generated $2 million in annual earnings on $8 million of net tangible assets, throwing off cash that could be redeployed. The machine was starting to operate. The pattern is unmistakable when you look at the actual records. Between 1970 and 1985, Berkshire acquired or made major investments in National Indemnity and other insurance companies. The Washington Post in 1973, Geico Insurance starting in 1976, Buffalo Evening News in 1977, See's Candies, and dozens of other businesses. Each acquisition was analyzed not just for standalone returns, but for how it fit into the larger capital allocation machine. Insurance provided permanent float. operating businesses generated cash flow. Both fed capital back to headquarters. Headquarters, meaning Buffett and his partner Charlie Munger, could allocate that capital wherever returns were highest, without the constraints that limited other investors. This was not new. J.P. Morgan used depositor funds from banking operations to finance industrial consolidation in the early 1900s. But Morgan faced depositor withdrawal risks. Buffett's insurance float had no such vulnerability. Policyholders could not withdraw. By 1985, Berkshire's insurance float had reached $1.2 billion. The textile operation was shut down in 1985. It had been bleeding money for years. But it no longer mattered. The shell remained. The name remained. But the substance had transformed completely. When most people think of Berkshire Hathaway, they think of Buffett picking stocks.
But here is the key question. Where did the money come from? The answer? Increasingly, it came from insurance float that cost less than zero. Between 1965 and 1985, Berkshire's float-to-equity ratio grew from 0 to over 2 to 1. That means for every dollar of Berkshire's own money, it had access to $2 of policyholder money. And here is what really reveals the pattern. Buffett's insurance operations have generated underwriting profits in most years. That means the float did not just cost 0% interest, it carried a negative interest rate. Policyholders were effectively paying Buffett to hold their money while he deployed it at 15 to 20% returns. The logic was simple. Collect premiums exceeding claims, build float, invest float in businesses generating high returns, use those returns to grow insurance operations. More insurance equals more float equals more investments equal more capital equals larger insurance operations. Each step made the next unavoidable. This was a self-reinforcing flywheel that compounded wealth with mechanical precision. The system entered full operation in the late 1980s and 1990s. By 1990, Berkshire's insurance float had grown to $1.6 billion. The company held major positions in Coca-Cola, acquired in 1988, American Express, Wells Fargo, and Gillette. Each stake represented billions in market value. But here is what the conventional narrative misses. These were not just stock investments. They were deployments of permanent, low-cost capital into positions that could be held indefinitely without tax consequences or redemption pressures. Think about what this meant in practical terms. A mutual fund manager facing quarterly redemptions cannot hold a stock through a 50% drawdown. Buffett could. A hedge fund charging 2% annual fees and 20% of profits needs to generate returns exceeding those costs. Buffett's cost of capital was negative. He was being paid to invest. A private equity fund with a 10-year life needs to sell assets. Buffett never had to sell unless he wanted to. He operated outside normal constraints. In 1990, Berkshire acquired $358 million of preferred stock in Gillette. By 1996, that investment had grown to $3.5 billion, a tenfold return in 6 years. The Coca-Cola stake, purchased for $1.3 billion in 1988, reached $13.3 billion by 1998. Those returns compounded tax-free inside Berkshire. The unrealized gains meant no capital gains taxes. The cash accumulated, and the insurance float kept growing. By 1995, the float reached $3.4 billion.
By 2000, $27.9 billion. The scale of the advantage is staggering when you look at actual records. In 1999, Berkshire acquired General Re, a major reinsurance company, for $22 billion. General Re brought $15 billion in additional float. The acquisition was messy. Integration took years, but the float became permanent capital. This was not just about insurance anymore. In 1998, Berkshire acquired Executive Jet. In 2000, it acquired Mid-American Energy, a utility holding company with regulated earnings and steady cash flows. In 2003, Clayton Homes, a manufactured housing company. The pattern repeated. Acquire businesses that generate predictable cash flows, require modest capital investment, and can be operated indefinitely. Feed their earnings back into headquarters. Redeploy into the next opportunity. The parallel to historical conglomerates is striking, but with a critical difference. Conglomerates like ITT and Gulf and Western in the 1960s used accounting gimmicks and stock-based acquisitions to create the illusion of growth. When the market turned, the structures collapsed. Berkshire's model was different. It used permanent capital from insurance float and retained earnings from operating businesses. No accounting tricks, just mathematics. Capital deployed at 15 to 20%, compounding over decades. By 2005, Berkshire's insurance float had reached $49 billion. The company owned over 70 operating businesses outright, from Fruit of the Loom to Dairy Queen to NetJets. The stock portfolio exceeded $50 billion. Book value had grown from $19 per share in 1965 to over $59,000 per share by 2005, a compound annual growth rate of 21.5% for 40 years. But that was just the beginning. What came next would demonstrate the system's resilience. In 2008, the financial crisis struck. Lehman Brothers collapsed. AIG failed. Washington Mutual failed. Credit markets froze. Stock prices plummeted 50%. For most investors, this meant disaster. For Buffett, it meant opportunity. In September 2008, Berkshire invested $5 billion in Goldman Sachs preferred stock, receiving warrants that would generate billions in additional gains. In October, another $5 billion into Bank of America preferred stock. In 2009, $2 billion into Dow Chemical. Berkshire was the lender of last resort, the entity with capital when everyone else faced redemptions. Think about the timing. When the financial system was collapsing, Berkshire had $24 billion in cash and tens of billions more in liquid securities. No one could force Buffett to sell. No redemptions, no margin calls, no quarterly performance reviews. The insurance float continued growing. By 2010, it reached $66 billion. By 2015, $88 billion. The machine kept operating. Between 2008 and 2016, Berkshire acquired Burlington Northern Santa Fe Railroad for $44 billion. Heinz, in partnership with 3G Capital, and Precision Castparts for $37.2 billion. The scale was staggering. These were acquisitions of entire corporations with tens of thousands of employees and billions in annual revenue. And here is where the pattern becomes most clear. Every acquisition was structured to ensure cash flow returned to Berkshire headquarters for redeployment. By 2018, Berkshire Hathaway owns 68 operating businesses, directly generating over $240 billion in annual revenue. Insurance operations with $123 billion in float, stock positions worth $173 billion in companies like Apple,
Bank of America, and Coca-Cola, and cash reserves exceeding $100 billion. The total market capitalization exceeded $500 billion. Warren Buffett owned 16%, worth approximately $80 billion. Those who had invested $10,000 in Berkshire stock in 1965 held shares worth $270 million by 2018, a 27,000-fold return in 53 years. This was not stock picking. This was a machine that converted patient capital and structural advantages into compound returns that exceeded every major investor in history. The breaking point for most patterns comes when growth becomes impossible or advantages disappear. For Berkshire Hathaway, that moment approached not through failure, but through scale. By 2020, the company had become so large that finding investments big enough to matter became increasingly difficult. Float had reached $146 billion, but opportunities to deploy it at historical rates were shrinking. Berkshire's cash position swelled from $100 billion to over $140 billion. At Berkshire's scale, acquiring a billion-dollar company barely moved the needle. It needed $10 billion opportunities, and those were scarce at prices Buffett considered reasonable. Then COVID-19 struck. In March 2020, markets collapsed 35% in 23 days. This was Berkshire's moment, the crisis Buffett had been waiting for. But here is what surprised many observers. Berkshire did relatively little. It sold airline stocks at losses. It bought some Bank of America shares. But the massive acquisitions many expected never materialized. Instead, Buffett announced in August 2020 that Berkshire would begin buying back its own stock aggressively. Between 2020 and 2022, Berkshire repurchased $68 billion of its own shares. This was a breaking point of a different kind. Not failure, but recognition that even Berkshire itself, valued at over $600 billion, represented one of the best available uses for Berkshire's capital. The pattern had reached a scale where it began consuming itself. But here is the key question. Did the advantages disappear? The answer is no. In 2021, Berkshire's insurance float reached $147 billion. In 2022, it grew to $164 billion. The operating companies generated $30.8 billion in earnings. The machine continued operating. In 2022, Berkshire made its largest acquisition in years. It purchased an additional $20 billion worth of Apple stock, taking its total position to $156 billion by year-end. It also bought $10 billion of Occidental Petroleum and $8 billion of Chevron. Energy, technology, insurance, railroads, utilities. The same diversification strategy. The same flywheel, still spinning. What changed was not the system, but Warren Buffett's age. Born in 1930, he turned 90 in 2020, 92 in 2022, 93 in 2023. Charlie Munger, born in 1924, passed away on November 28, 2023, 1 month short of his 100th birthday. The partnership that had built Berkshire was ending, not through failure, but through mortality. Greg Abel, vice chairman of Berkshire's non-insurance operations, was named as Buffett's successor. Ajit Jain continued leading insurance operations. But the question remained, could the pattern continue without its architects?
history suggests a challenging answer. Every time a founder-led capital allocation machine transitions to professional management, performance typically declines. Jack Welch to Jeff Immelt at General Electric. The first generation builds the machine. The second generation operates it. The third generation often dismantles it. But here is what is different about Berkshire. The structure is now so large, so diversified, so embedded in the American economy that it has become nearly impossible to dismantle. The insurance operations generate $164 billion in float automatically. The operating companies produce $30 billion in annual earnings automatically. Even if Berkshire's management becomes mediocre, even if they deploy capital at merely market rates, the machine will continue generating wealth through sheer momentum. But here is where the current situation reveals the final constraint. Berkshire now faces regulatory barriers its founder never faced. At $780 billion in market capitalization as of 2023, Berkshire cannot easily acquire companies in many sectors without triggering antitrust scrutiny. Banking regulations limit insurance company ownership in banks. The structural advantages that allowed Berkshire to grow from $22 million to $780 billion over 58 years now create barriers to future growth. The immediate aftermath of Munger's death in November 2023 saw Berkshire's stock reach new highs, crossing $620,000 per Class A share. Investors recognized that while Munger was essential to building the machine itself now operated independently. So let us connect all the pieces. Warren Buffett did not become the greatest investor in history simply by reading financial statements better than others, though he did. He did not succeed merely by being more patient, though he was. He did not win through superior stock picking alone, though his record is unmatched. What Buffett discovered, systematically exploited, and built into a self-perpetuating machine was a structural advantage that operates outside normal market constraints. Permanent capital with negative cost. The pattern traces through every phase. The Graham-Newman Foundation teaching him to quantify value and exploit market inefficiency. The Buffett Partnership aligning incentives and proving the methods worked. The Berkshire Hathaway transformation turning a failed textile mill into a holding company. The insurance acquisitions creating $164 billion in float that costs less than nothing. The deployment of that float into operating businesses generating predictable cash flows. The reinvestment of those cash flows into additional insurance and operating businesses. The complete vertical integration of capital sources, allocation, and deployment under unified control. This was not stock market investing. This was engineering of financial physics. Every component served the larger system. Insurance provided leverage without the cost of debt. Operating businesses provided earnings without quarterly reporting pressures. The holding company structure provided tax efficiency and permanent capital. Buffett and Munger provided the allocation skill. Together, they created returns that compounded at 19.8% annually for 58 years. That is not twice as good as the market's 9.9%. That is 43,206 times your money versus 238 times.
The difference between $432 million and $2.4 million on a $10,000 investment. The question is, what happens next? The institutions remain. Berkshire Hathaway still owns BNSF Railway, Geico, Berkshire Hathaway Energy, Clayton Homes, See's Candies, and 68 other operating companies. The float still exists, $164 billion, earning negative interest rates while generating investment returns. The stock portfolio still holds $354 billion as of year-end 2023, concentrated in Apple, Bank of America, American Express, Coca-Cola, and Chevron. The machine still operates, but the specific pattern that transformed Berkshire from 1965 to 2023, the discovery and exploitation of insurance float as permanent negative cost capital deployed by genius-level allocators into asymmetric opportunities. That pattern is ending. Not because it failed, because it succeeded so completely that it reached the limits of scale. At $780 billion in market capitalization, Berkshire can no longer grow at 19.8% annually. The mathematics make that impossible. Matching its historical rate would require adding $154 billion in value annually, more than the entire market cap of Johnson & Johnson. The parallel to previous capital allocation machines is clear. Andrew Carnegie's U.S. Steel dominated its era, then calcified. J.P. Morgan's financial empire shaped American industry, then faced regulation. John D. Rockefeller's Standard Oil achieved unprecedented scale, then was broken apart. Warren Buffett's Berkshire Hathaway achieved returns unmatched in financial history, and now faces the final constraint, its own size. The only question is whether the machine can continue generating above-market returns at reduced rates, or whether it gradually converges to market-level performance as its advantages erode and its founders pass. The evidence from 6 decades suggests the structure itself remains sound, but evidence from all of financial history suggests that founder-driven outperformance rarely survives succession. We are living in a world shaped by Warren Buffett's pattern. Every insurance company now thinks about float as investable capital. Every conglomerate studies Berkshire's decentralized operating model. Every value investor recites Buffett's principles. But we are also living in a world where the specific constellation of factors that enabled Berkshire's success, the combination of underutilized insurance float, undervalued public companies, minimal regulatory constraints, and once-in-a-generation capital allocation skill, may never align again. The pattern says structural advantages compound over time. The evidence says those advantages eventually attract competition or regulation. And history says the ending is always the same. What begins as revolution becomes institution. What begins as advantage becomes constraint. And what begins as growth becomes maintenance. Warren Buffett turned $105,100 in 1956 into $120 billion by 2023. That is a 1,142,276-fold increase in 67 years. The machine he built will continue operating, but the pattern that created it belongs to its time. And the only certainty is that time, like all assets, eventually depletes.